Hello friends, everyone. In today's session, we are going to discuss reinsurance. So this is one of the quite interesting topic or having a significant influence in the insurance industry. So let's study an insurance and how the reinsurance things applicable works. First of all, you know that you as a customer, you take an insurance policy. As a policyholder, you take an insurance policy to indemnify against the losses in case if you suffer a losses. Suppose if you have taken an insurance policy that is a motor car insurance policy, then in case if an accident happens or a loss is caused to your car, then the insurance companies who comes in the picture and compensate you for the losses that has been suffered by you. So in this way, the insurance is a protection against the financial loss caused to you. Now, the insurance company who is accepting your risks, they also wants to reinsure their risk. What the risk they are accepting from our policyholders or from a debt market, from our customers, they now want to reinsure their risk. So insurance company are approaching to the reinsurer for the risk that they have already accepted from the policyholder or from the customers. So the insurance company who's called as a primary insurance companies who are called as a primary insurers, who is called as a primary insurers, approach the reinsurer for a risk they have accepted from the policyholders. So this, this is a policy holders who have taken a policy for motor. This is a policy taker holder who has taken a policy for his property, for life or health or business or catastrophic events. So they are approaching to the direct insurers. Direct insurers are often called as primary reinsurers. Primary insurer. So primary insurer. So primary insurer insurance companies accepting the risk and in consideration the policy holders are paying a premium to the these insurers. These insurers are later on transferring the risk to the reinsurer because the primary insurer is not in a position to accept the risk in large quantity. So they are transferring a risk to the reinsurers. And the reinsurers, they are transferring a risk to the reinsurer. So in this way, the mechanism actually works. This is the way how the mechanism works. The risk which is already being accepted by the primary insurer is transferred to the reinsurer. So in this way, we can say a reinsurance is the process of reinsuring the risk which is originally accepted by the primary insurer or direct insurer for a consideration return called premium. So these are the parties involved in the reinsurance. One is the policyholder. So policyholders means an individual who is initially exposed to the risk. That is called a policyholder or the customer. Direct insurer, preferably similar risk with the independent loss events to obtain a balanced insurance portfolio, or in simple words, we can say the sitting insurer or the primary insurer is called a direct insurer who is no exposed to the risk that they have accepted from the policy holder. The reinsurer. So primary insurer cede an actual or catastrophic risk to another professional insurance. So the primary insurer means a cede means the transfer of risk. So what the risk that the primary insurer has accepted is ceded or transferred to the professional insurance company which is called as reinsurer. So this is a new terminology, retrocessioner. Retrocessioner works on the same principles, on the same lines of on the same lines as the works direct insurer or reinsured works. So when reinsurer are getting the risk that he has accepted from the direct insurer, it's transferred to another party is called the retrocessioner. So it is the reinsuring of the risk which it already reinsured. So the relationship between direct insurer and reinsurer is the same as between the reinsurer as the retrocessioner. So retrocessioner is, accepting a risk which is accepted by the reinsurer. Retrocessioner is accepting the risk which is, accepted by the reinsurer, for which the reinsurer is paying a part of premium to the retrocessioner. And retrocessioner is accepting a risk. It is providing a risk protection to the reinsurer. So reinsuring of the risk which is already reinsured is being done through a process called retrocessioner. So reinsurance gave away a retrocede. So reinsurer, what he has accepted a premium, what he has accepted a risk, is being transferred to another party that is called as retrocessioner. So these are the benefits that provided by the reinsurance. So reinsurance industry plays a pivotal role in driving the growth of insurance industry. First of all, the insurance is written on the strength of the reinsurance support. Because when the primary insurer knows that they have been backed by the reinsurance company who is going to insure their what they have accepted from the policyholders. So the insurance companies, primary insurance company, have the ability to they have the ability to accept more risk or to handle the risk from the direct market or from the policy holders. The risk flow through insurer to the reinsurer, as no the risk is being passed from the insurer to the reinsurer through a reinsurance mechanism. Reinsurance is the foundation for the economic growth through risk transfer mechanism. Reinsurers spread the risk across the world. Reinsurance spread the risk across the world. So, the reinsurance, they are not confined to any particular country or the nation. They can accept the risk from the overseas world. They are being providing a financial protection to the insurance companies who have been carrying overseas operation or their units are located outside the country or outside the home country. So in this way, we can say that reinsurance is, plays an important role in driving the growth of the insurance industry. So reinsurance supports aim at providing insurance capacity to write more insurance business because they gives you a protection, they gives you a back-end support, back-end financial support on the basis of which the insurance company is able to write more business. They can enter into the fields which they have not entered earlier. So they can enter into the more fields, they can expose to the more field, or they can provide a financial protection easily because they have been backed by the reinsurance companies. So providing insurance protection against the bottom line volatility. So any volatility is being faced by the primary insurer with regards to the risk they have accepted is being protection is being provided by the reinsurance company. So providing insurance protection against large and catastrophic losses. So let's say floods occurs and flood cyclones occurred, which has resulted into the loss across the various lines of business. Like due to floods, the automobile uh, claims is being reported, personal life accident claim being reported, and the damage to the household promises being reported. So there are so many losses being arise due to any catastrophic loss or just and when the catastrophic losses occur, the insurance companies finds the difficulty or their solvency position is not so good to bear that catastrophic losses. So in that case, the reinsurers who comes into the picture or provide a financial protection to the ceding insurer company to provide a protection against the catastrophic losses. So this, by way of the reinsurance, the to primary insurance in a position to meet the, policyholders claims obligations like policyholders obligations. They are in a position to provide a financial protection to the policyholders without much, without affecting too much about their erosion of capital because they know that key when they are paying a claims in huge number or the catastrophic loss occurred, If they are not being covered by the reinsurance policy, then there will be a capital erosion of the primary insurance companies. So the protection to their capital is only possible when they have adequate reinsurance coverage. In case, especially in case of catastrophic loss. So talking about the benefit of the reinsurance to the insurance companies. So these are the things: reduce risk exposure, assess to expertise, lower premiums, greater capacity, and improve financial stability. These are the we have discussed. So these are the basic benefits of the reinsurance for insurance company and the policy holders. When the reinsurance company share losses with the primary insurer, then in this way, the primary insurer claim cost is being reduced because the initial loss is being recovered from the reinsurance company. When the loss is reduced, then definitely it resulted into the lower cost ratio, incurred claim ratio. And when there is a lower cost on the part of the primary insurer, when there is a low claim on the part of the primary insurer, then due to low claim cost, they can provide a benefit to the policyholder in the way of lower premiums. As no higher the claim cost, higher would be the premiums. Lower the claim cost, lower would be the premiums. Since the lower cost claim cost possible only when they have educate coverage or they have educate support from the reinsurer. This is only possible, and due to which the lower cost will be passed to the policyholders in terms of lower premiums. So let's talk about the framework of reinsurers in India. So Indian reinsurer, only one Indian reinsurance is registered with the regulatory authority, that is BIC. It provides a support to the direct insurers in India, receive an obligatory cession on every policy from domestic general insurer, which is currently a rate is 4%. So the minimum it means whatever the premium that is being written by the direct insurer is automatically passed to the Indian Reinsurance GIC, that is obligatory cession, that is minimum 4%. So receive obligatory cession on every policy that is being written by the domestic general insurers. So foreign insurance branches, when there are certain foreign insurance branches which are being operated in India. As per the Insurance Law Amendment Act 2015, allowed foreign reinsurance and Society of Lords open up branches in India. There are 13 foreign reinsurance branches in India. Okay, as of for financial year 2022. So foreign reinsurance branches book gross reinsurance premium income in India approximately 24,000 crores in financial year 23-24. This is might be a statistic information which not be relevant for the exams, but still you may get a awareness of the how the foreign insurance branches are doing in India. Since talking about the cross-border reinsurers, insurers with no physical presence in India but carry on reinsurance business with Indian insurers. So the cross-border insurance means they are don't have any physical presence in India, but through the tie-up with the Indian uh, insurers or the domestic insurers, they intend providing a financial protection to Indian market, to Indian insurance industry. So they have no physical presence in India, but they are carrying a reinsurance business with Indian insurance as per the guidelines or the framework laid down by the IRD, Insurance Regulatory Development Authority of India. As of financial year 2023-24, there are about 280 cross-border insurers participated in Indian reinsurance business. So, as of financial year 23-24, there are about 280 cross-border reinsurers that is who was participating in India insurance business. So, if we're talking about the gross reinsurance premium, so GIC Re having the 51% and the foreign reinsurance branches hold 59% of the premium. So the gross written premium for the financial year 23-24, GIC was having the 51%, GIC Re and 49% with FRB, foreign insurance branches. So let's study about the Jan Insurance Corporation of India. GIC was, formed under the Jan Insurance Business Nationalization Act of 1972. So the Jan Insurance business was nationalized in the year 1972, and the GIC Corporation of India was formed under the JIPNA Act for the purpose of superintending, controlling, and carrying on the business of General Insurance in India by providing a reinsurance support to the insurance companies. So, the GIC was primarily responsible for the carrying the operations, supervising the operation of the four public sector general insurance companies, that is New India, Oriental, National, and United India Insurance Company Limited. So the GIC was formed, to supervise the functions of this four uh, state-owned general insurance companies, right? So in year 2000, the GIC was given a status of the independent reinsurer, and the subsidiaries of the GIC, that is four insurance companies: New India Insurance Company having headquarters in Bombay, Oriental Insurance Company having headquarters in Delhi, and National Insurance Company having headquarters in the Kolkata, and United India Insurance Company having headquarters in Chennai. Their ownership is transferred to the Ministry of Finance, Government of India, Minister of Finance and Government of India. So the GIC was known as renamed as GIC Re, and it is a primary reinsurer, given a status of the primary reinsurer in India, or solely a primary reinsurer in India in year 2000. So the GIC Re, so the domestic largest reinsurer in the domestic reinsurance market in India and a major reinsurer internationally. Company has become an effective reinsurer partner for the Africa Asian region. It also provides the reinsurance solutions in the international market and has become a leading global reinsurance company having presence in around 137 countries. It provides a reinsurance support to 59 direct general and life insurance companies in India, making it a repository knowledge and data about the sector and the market. Key segments are targeted by the GIC Re are property, agriculture, crop, liability, motor, health. So it has a strength of 457 employees, out of which 35 are male, and average age of the employee is 40 years. So these are the key financial metrics of the GIC Re. So ranked 10th as a largest global reinsurance group, and having a rating of A as an excellent given by the credit rating. And market share in India, the GIC Re having the market share of 51%, 49% is market share is being having with the cross-border reinsurers or the foreign reinsurance branches. So having a significant ownership by the government, that is 82.40% as on March 25. So this is the gross written premium wrote by the GIC Re, that is 41,000, and having this combined ratio of 108%. So it is a loss-making entity when we are talking about in terms of the business they have procured, and in terms of the business they have procured, and the claims they are paying. So this is a profit after tax. Considering the investment income, they are able to generate a profit to the shareholders. So having a good solvency ratio, that is 370%, that is 3.7% is the solvency ratio. That is absolutely good against a parameter of 1.5%, which is laid down by the regulator.